Welcome to The Explainer. Today, we're tearing into one of the wildest, most explosive financial stories unfolding in the markets right now. As of August 2026, we are witnessing an absolutely historic, face-melting rally in commodities and equities. We're talking about gold, yes, but actually, more importantly, we're talking about the massive profit-generating engine of gold miners, specifically Newmont Corporation, ticker symbol NEM. We are going to unpack exactly what is happening beneath the surface of this historic rally and why the real story isn't just about the shiny metal itself.
Okay, let's dive right into this. Gold has completely blasted into uncharted territory. We are literally talking about $4,628 an ounce. You know, this is absolutely not your grandfather's slow-moving inflation hedge. This is a violent, explosive move where the metal gained over 11% month to date and roughly 3.4% in just a couple of trading sessions leading up to our late August data point. When an asset class this massive moves with this kind of breathtaking velocity, the entire financial world has to pay attention. It completely reshapes the landscape of global wealth.
But, well, here is the shocking secondary effect. While everybody else is totally hypnotized by the metal, Newmont Corporation is making gold's rally look like a warm-up act. NEM surged an incredible 41.4% in just 4 weeks. I mean, think about the sheer scale of that outperformance for a second. The stock of the company mining the gold is absolutely rocketing past the performance of the underlying asset itself. It is a staggering divergence, and it demands a much closer look.
So, the billion-dollar question we have to ask ourselves is this. Has the gold mining boom only just started, or is NEM already way too expensive? When you see a 41% jump in a single month, it's completely natural to feel like, hey, I missed the boat. To answer that, we have to look under the hood and figure out if we are at the very beginning of a massive fundamental run driven by actual cash, or if we're nearing the end of a speculative spike driven by pure momentum.
Section 1. The Operating Leverage Engine. Let's look at the mechanics of gold mining.
To really grasp why a miner's stock can just rocket past the metal itself, you have to understand operating leverage. It's basically this financial magic trick where a company's profits grow exponentially faster than its revenue. And why does this happen? Well, because Newmont's fixed costs don't rise dollar for dollar with the selling price of gold. Think of it almost like a software company's margins. Once the initial code is written, selling one more license is almost pure profit. In mining, if gold goes up $100, the miner's cost to dig it up stays relatively flat, meaning that extra $100 goes almost entirely straight to the bottom line. So Newmont isn't just a bet on gold going up. It's a heavily amplified bet on the widening gap between the selling price and the extraction cost.
And the math brilliantly illustrates exactly what we're talking about. Just consider the massive gap between these two figures. Newmont's all-in sustaining cost, or ASCC, which is basically the total price tag to keep the lights on, maintain the equipment, and actually dig out an ounce of gold, they've guided that cost for 2026 to be around $1,680. But the selling price? It's sitting north of $4,600. Now sure, ASCC isn't the exact final profit margin since you still have corporate taxes and financing costs, but the spread is undeniable. That is a jaw-dropping $2,900 gross margin per ounce. The sheer math of it means even if gold prices somehow decline substantially, Newmont could potentially still operate with incredible cushion-thick margins.
Moving on to Section 2, Newmont's massive cash flow. We're looking at the verified data from Q2 2026.
Let's see how this operating leverage actually translates into real-world numbers, because the sheer scale of cash generation here is staggering. In Q2 of 2026 alone, Newmont produced 1.3 million attributable gold ounces. Thanks to that massive financial leverage we just talked about, that translated into $2.2 billion in free cash flow. That's in a single quarter, not revenue, folks, free cash flow. They also generated approximately $2.9 billion in operating cash flow. This is the exact moment where a macroeconomic story about a precious metal completely transforms into a story about a massive corporate cash printing machine.
But let's do a quick reality check here. Sky-high gold prices are totally useless if the metal just stays in the dirt, right? 5.26 million. That is Newmont's target for 2026 attributable gold ounces. To get this massive cash explosion, you need a holy trinity to align perfectly. Significantly higher gold prices, millions of ounces actually produced without operational delays, and strictly controlled internal costs. When you combine robust volume with expanding margins, that is exactly how you unlock potentially enormous, market-beating cash generation.
So, what do you do with all that cash? You give it back.
Since their previous earnings call, Newmont actually reported returning roughly $1.9 billion to shareholders. As this perfectly captures, investors aren't just buying a shiny rock anymore. They're potentially buying free cash flow, dividends, and share repurchases. This dynamic fundamentally rewires the investment thesis. It turns a basic bet on commodities into a highly lucrative capital return story, which is all supported by a fortress balance sheet and solid production growth.
Section 3. Macro drivers and the risks. Let's talk about the forces moving the market right now. Of course, we know no financial asset defies gravity forever, but let's look at the macro forces creating this perfect storm for gold right now. It's an incredibly potent cocktail. We've got lower interest rates, which suddenly make non-yielding assets like gold look phenomenal compared to bonds. We have a weakening US dollar, and since gold is priced in dollars, that currency movement is a massive tailwind. Combine all that with relentless structural central bank buying, intense geopolitical anxiety acting as a safe haven magnet, and skyrocketing fiscal debt concerns globally. Capital is fleeing traditional financial assets, and gold is basically acting like a giant sponge, soaking it all up. But remember, Newmont is an operating business, not a low-volatility gold substitute. Think about the vice grip of operational costs here. A high gold price doesn't automatically guarantee expanding margins, because those operational costs can silently, and I mean silently, squeeze the life out of those profits. We are talking about the unrelenting costs of labor, diesel, heavy equipment, energy, taxes, and royalties, not to mention the excruciating expense and timeline of permitting and environmental requirements. If inflation stays sticky, or say a single individual mine faces a severe operational hiccup, costs spike, and those beautiful, wide margins we saw earlier can get crushed fast.
Section 4. The bull versus bear case. It's time to weigh the valuation. Let's keep things objective here. On the bull side, the argument is an absolute juggernaut. You have record margins, a jaw-dropping $2.2 billion in quarterly free cash flow, and massive shareholder returns via that $1.9 billion payout, all anchored by strong 2026 production guidance. Symmetrically, though, we have to look at the bear case. Newmont's stock is already up 41% in just a few weeks. Gold is an inherently volatile asset. If the dollar suddenly strengthens or geopolitical tensions cool off, gold drops. And because NEM is a leveraged operating entity, a small drop in gold could trigger a violently sharp correction in the stock. Buying a stock after a 41% face-ripping surge is a profoundly different risk profile than buying it before the breakout. The price you pay today absolutely matters.
Now, you'll hear analysts screaming on financial networks that gold is going to $5,000 or beyond by 2027. But you know what? That's a forecast, not a strategy. The much smarter investment question right now is this: what happens to Newmont if gold just stays put? We don't need $5,000 gold for Newmont to win. If the metal just hovers right here at its current $4,600 range, that massive gap above their $1,680 cost base remains firmly intact. It continues generating a staggering river of cash quarter after quarter, totally independent of whether gold ever hits a new all-time high again.
Which brings us to the bottom line. The 2026 gold boom is historically significant. The fundamentals are verified, and the cash flow generation is frankly staggering. But here is the hardest question you have to ask yourself before deploying any capital. How much of that boom is already baked into NEM's stock price today? When a stock jumps 41% in a month, the market is aggressively pricing in all the good news and leaving very little margin for error. The fundamental opportunity is undeniable, for sure, but so is the valuation risk. So, does the current price tag leave any room for a positive surprise? Or are you just paying a massive premium for yesterday's news? Thanks for joining me on The Explainer today. Dig into these numbers and decide for yourself exactly where you stand on the great gold rush of 2026.